Welcome to Subramani. I'm going to talk about a very difficult topic. One statement which all financial bloggers, planners, anybody will tell you is, in the long run, equity gives better returns than debt. Okay. Now we have to understand that this is true in the American context. It is true in the Indian context, but this was not true perhaps in the Italian context. Last 50-year return in the Italian markets is something like minus 0.5% or something like that, right? So I'm talking of real returns. So there are markets, maybe Switzerland, Japan, Italy. I'm just saying, I'm not very sure that it is an exhaustive list. All have given very poor returns over 10 years, 20 years and 50 years, right? So what do you have to say for this? Another worry is, what can you learn from history? That's another difficult question to answer, is because history teaches you only one thing: don't try learning from history, don't do a cut paste. It's very difficult to sustain. So if you take from 1979 to 2024, I don't think there has been a 6-year or a 7-year phase where you have got only positive returns. Even 2002 to 2007 was just 5 years, and one of those years I think the return was 3.5%, right? Whereas if you take from 2016 to 2024, we have got fantastic returns in equity. In fact, it is too good to be true, which means it can't be true. So someday there will be a year with negative returns, let us say March or December, however you want to take it at. We will stick to March because most data in India will be available for March. I can assure you there will be some years of negative return to compensate for this excessive bull market which we have seen over 6 years, right? But having said that, the last 10-year return or the last 12-year return in India, adjusted for inflation, may just be about 12%. Now that is not too high, but 2-3 good years backed by another good year is going to trigger something which will bring it to a negative return. Now why am I talking about this? Because how a bubble gets built is you take a good belief and then you just keep on extending that belief. So let's say 2015 or 2014, nobody in your house believed in equity, but you started doing an SIP. Now for 6 years you have made money. You have doubled your money, tripled your money, whatever, you have done very well compared to your fixed deposits. So now you go and tell your father, see, compared to your fixed deposit, this is done much better, the taxation is lower, etc., etc. So your father says, very good, let me remove some money from the bank and put it into equity markets, and he puts a lump sum. What happens if things go wrong? Because what is a bubble? I think I don't think anybody can describe it better than what Warren Buffett has done. This was in an inquiry which was done by American authorities to say to find out why why the market falls, why bubbles get created, etc., right? So 2029 is the time when everybody is going to visit the 1929 problem, and we will see whom to blame, because obviously it's not our mistake, somebody else has to take the blame. Who will it be? So Buffett's explanation of a bubble was so beautiful. He said, he spoke about the housing bubble. Now you remove the word housing and you put equity and you will see it perfectly fit there. So this is the basic course, embedded in psychology. It was a pervasive belief that house prices couldn't go down, right? Most of us believe. You try telling this to anybody that real estate prices can go down, they won't believe it. They say, no, not true. It is, my father bought for 1 lakh, it is worth 1 crore. Maybe there's a 4% IRR or a 6% IRR, but then this folklore that my father held for 30 years made money, held for 242 years made money, that doesn't go away. So that's what he's saying. And everyone, virtually everybody succumbed to that. Now that's the only way you get a bubble, is when, this is beautiful, basically a very high percentage of the population buys into some originally sound premise. It's quite interesting how that develops. right? So like I said, you put money over last 6 years, you made money, so now your dad, mom, aunt, neighbor, boyfriend, girlfriend, potential father-in-law, real father-in-law, everybody starts putting money into this, and everybody believes, oh, like this guy made money, we are all going to make money. That is how a bubble develops. And then he says the originally sound premise is equity will give better returns than debt. That is true, even today that is true, but it has some caveats. It's not that permanently true. It is not that last year you got 24% in equity and you got 7% in debt, so this is going to sustain for the rest of your life. So next 20 years you will get 24% every year and 7% is what you will get in the bank. If this was true, all the money would shift from the bank to the markets, right? It does not happening. It is not happening. It does not happen. Why? Because of uncertainty. One day when the market doesn't do well, and the market will give you perhaps 11% or 12%. If the bank FD is 8%, you will get 11% or 12%, but you will not get it in a straight line. There is a high standard deviation. So he says the originally sound premise that becomes distorted at some time passes as time passes, and people forget the original sound premise and start focusing only on the price action, right? Last year 24 mila, ye saal 25 milega, kind of a thing. So the media, the investors, the mortgage bankers, the public, I mean your aunt, uncle, his dog walker, everybody, and obviously the ruling government, everybody believes that this is permanently true. And people overwhelmingly come to believe that house prices will not fall significantly. So if everybody believes that equity returns will be higher than debt returns, fairly obvious that a lot of money will flow from the banking sector to the equity markets, and those guys make more money. So which means it will bring more and more people. So I mean, I'm not getting into right or wrong, but then expectations have to go down. If you have got 24% return in a stock in the last 1 year, I think it could perhaps be a great time to partially sell something and keep the balance, right? So I'm not suggesting market timing or anything based on what has happened, but based on your own appetite for taking risks. Having seen such a fantastic run, if you don't take your profits and do something, maybe repay a loan, maybe buy yourself a camera, maybe buy yourself a car, maybe repay the car loan, maybe buy a bigger house, I don't really care. It's a great time to be doing that, right? So after that, our friend Warren Buffett also said about my former boss Ben Graham made an observation 50 odd years ago to me that it really stuck in my mind, and I have seen evidence of it. He said you can get into a whole lot more trouble in investing with a sound premise than with a false premise. If somebody tells you that I will give you 12% per month, you will laugh at him and say no, this is not going to happen, this is not sustainable. Even if somebody promises you 3% per month, you will translate and say 36% is not possible. However, when a relationship manager in a bank creates charts and says look, last 5-year returns of SIP has been 34%, last 5 years return has been 21% and 18% and 19%, and completely made you believe that the return over the next 5 years will be 19 to 36%, somewhere between that, right? He has not said it at all. He has also put a clause saying the past result is not an indicator of future return. However, the mind which does not want to listen just hears that 19 to 36% as the range of returns that people have got in the last 5 to 10 years. Is it true? Yes, it is true. How do you have to hear it? You have to hear it as saying this has happened, full stop, Control Alt Delete, does not matter. Is it going to repeat over the next 3 years, 5 years, 7 years, 10 years? Answer is nobody knows. But we all know one thing, that the market goes through its bull and bear phases. Right now it's a bull phase, and a bull phase is a great time to be taking some money off the table and using it for whatever you have been creating that wealth. I mean, you can't ask your daughter to get married earlier just because the market is booming, but I'm just saying taking some money off and keeping it into debt instruments which are very safe. You don't want to even take the risk of keeping in the mutual fund, keep it in the bank fixed deposit, but removing some money from the market will make some sense, right? So any of these things, you realize that you take a good theme and say this is going to happen. Like I found somebody who had recently bought Nestle and I asked him, why have you bought Nestle? He says, oh, I get good returns. I said, where do you get good returns? He said, see, look at the price that I am paying for it. If I get 24% dividend, look at how much amount will be. So I was quite shocked to see the level of knowledge that he had, and he was a DIY in direct equity, right? So these are the people who could be causing the bubble, saying I don't understand, but if I buy any share, let's say I buy a share at 5,000 rupees and I know I'm going to get 24% dividend. 24% is not on the market price, it is on the face value. So if the face value is 100 rupees, you will get 24 rupees. If you use 10 rupees, you will get 2 rupees 40 paisa. It is selling at 5,000, 50,000, 1,20,000, 1,40,000, does not matter. You get dividend on the basis of the on the face value, right? So knowing, understanding these things is all pretty important. And then that is what, knowing all this makes you a good investor and makes you a better investor. Thank you.